Hello, chart watchers, and welcome to this Friday, March 2nd, Market Watchers Live Show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the market action so far today, you can see the Dow Jones down 174 points. It was down quite a bit more earlier, well over 300 points. So it is trying to battle back. We'll see how we close today because that's where we've been having our problems, is at the close. The S&P 500 also, after 3 pretty weak days, you can see trying to recover back all the way back to the flat line, which is good. The NASDAQ has recovered and gone positive. And the first index to actually show strength today was the Russell 2000. Small caps up about 0.75% today. Really having a pretty strong day after the last 3 days of selling. The 10-year Treasury yield's risen back up almost 7 basis points to 2.87% today. The volatility index, after moving up above the 26 level, has settled all the way back down to 22 as fear is subsiding a bit today. Healthcare is among the best performing areas of the market. You can see it up about 0.8% at the moment. Medical supplies, we'll talk about this again in a little bit, but on the daily chart was not looking so great, but on the weekly it was, and we are getting a nice rebound here, up close to 2% in this industry group within the healthcare space. Biotech's also doing very well within the healthcare. And what's not performing well today? Well, the industrials, after really 3 poor days. We were trading down quite a bit earlier today. We have recovered back toward the high of the day, though we are still down about 0.5% on the XLI. You can see the commercial vehicles, one of the areas really struggling today, but challenging key support from back in early February. So we'll see whether or not that can hold. And in the consumer discretionary space, McDonald's was their price target was slashed $20 by RBC Capital Markets. And I think it was relating to a slow start to their $1, $2, $3 menu. And you can see the traders not liking McDonald's today. The overall group not doing well. And again, we'll look at this in just a minute as well. But first, let me bring in my co-host, Erin. How are you doing this Friday morning, Erin?
I'm doing very good. Sounds like a little heartburn over there at McDonald's.
Yeah, there you go. You were waiting for that, weren't you?
I have all morning. No, actually, no. It wasn't that good to be waiting all morning for it.
You wanted to join that pun party. That's a good party.
Yes. No, I'm doing great. It's Friday. I mean, hey.
Yeah,
got hockey tonight. Got hockey on Sunday. I can't wait.
I was going to ask you if you had plans. You already answered it. Well, you're at every ball game today.
You betcha. You betcha.
Sweet. Well, we do have a bunch to get over. I know you've got your workshop coming up, so I'm just going to let you run with the announcements and the agenda, and let's get this thing going.
Yes, indeed. All right. So what's coming up in the next week? We have everything stock charts. Greg Schnell's going to come in on Tuesday to talk to us about some tips and tricks, I suspect. And we can see Martin Pring on Wednesday is going to come in. We're really honored that he's making another appearance on the show. And then we've got more coming up that week, but we'll share the suspense later. I have my avoiding analysis by paralysis workshop this morning after the technical news. Tom's going to cover off some momentum sleepers. The 10 and 10 to 1, our first symbol is going to be Citigroup, C. And finally, I'm going to finish up with a sentiment update for you and let you know what's going on with all of those charts and put-call ratios and all of that. And with that, I'll pass it back to you, Tom. I'm going to get my briefing ready, and you can take off with that technical news.
Sounds good. Well, let's start in the bond market. We got the 10-year Treasury yield, as I said earlier, up right now 6 basis points, almost to 2.87%. We closed below the 20-day moving average yesterday for the first time in 2018. I thought that was a little significant, but we have moved back above. And as I said recently, I'm actually expecting sideways consolidation. I don't think we're going to see a huge drop in the TNX. To the downside, possibly we could go down to this 50-day to 270, but I'm not so sure we're going to see that. Instead, what I would suspect is we're going to do a little bit of sideways consolidation and allow this 50-day moving average to come up from underneath. The only economic news out this morning, February consumer sentiment, 99.7. The market was looking for 99.5, so a little bit of good news there. And if I pull up the S&P 500 and we go to an intraday 10-minute chart, you will see that right at about 10 o'clock when the news came out, just past 10 o'clock is when we bottomed on the S&P 500 final time. Made our way all the way back up. But, you know, if we've seen this party before, it's because we just saw it 2 or 3 times this week. You could see back on Tuesday, we had an early move to the upside, and then the selling kicked in. Wednesday, we started up a little bit, and at about 10:30, 11 o'clock, started to roll back over again. Then we saw it again yesterday after an early move to the downside. We had this nice recovery up until about 10:30 or so, and then right back down again. So I'm not getting overly excited by the move back to the upside. I want to see it into the close. I think the most important time of the day, trading day, is between 2 o'clock and 4 o'clock Eastern. And as you can see, what we have been seeing over the past few days is selling from 2 o'clock to 4 o'clock. Even yesterday, we made a little bit of a rally and then right back down, a couple of swift moves late in the day. So I want to see that reverse. I'd like to see that this, you know, maybe we can sideways consolidate here for a couple of hours and then maybe make a strong push into the close. And then we might be talking about a bottom, another short-term bottom where we continue in this daily chart to consolidate. I'm still looking at maybe a triangle of some sorts. If we do bottom here, maybe we can connect, you know, from the candle bodies, connect an uptrend here. From the recent highs, we could connect a downtrend, and you could see maybe this squeezing symmetrical triangle. This is really what I've been expecting since we had the huge sell-off, is some sort of a bullish continuation pattern to emerge. And the reason, for those of you that are new, that I'm not looking for bearish patterns at this point is that we've still got money rotating into aggressive areas of the market. If you study history and you go back into 2006 and 7, and then maybe even back into the year 2000, before those 2 bear markets, we saw a lot of rotation taking place under the surface while the S&P 500 continued to try to meander higher. And Mark Chaikin on Wednesday, when he was with us, alluded to this as well. It's not so much the selling, it's what happens going forward as the market tries to recover. What kind of rotation do we see? That's really, I think, going to be the telling part of this, you know, consolidation, and whether or not we're really transitioning into a bear market or whether it is just a correction with another move to the upside. My bet at this point is on the latter, but we'll see. Time will tell. A couple of stocks that were in the news. McDonald's, as I mentioned, the chart looks horrible. You can see that, first of all, after the sell-off, many stocks came back, went right through their 20-day moving average, through their 50-day moving average, got close to recent highs or even made new highs. You can see from the relative performance here, McDonald's moving back up only to test its 20-day and moving back down. That was not a good technical sign. So I'm not surprised we're getting some bad news coming out of McDonald's. And if we pull up the relative chart, now let me get back out of there. I do need to organize my brain, but that's not what I was looking for. Here you can see the big drop, the failure at the 20-day and the big drop. And take a look at what's going on, not just with the absolute performance of restaurants and bars, but as I scroll down, you'll see, first of all, that McDonald's is definitely underperforming its peers. And that was pretty evident even before today's news. And then you look at McDonald's relative to the S&P. It's been declining since back in the early part of December. And then here you can see the restaurants and bars. Look at how far we are off of a relative high. That was back in June. Restaurants and bars on a relative basis, even when they strengthened back here, you can see, and I think technically I remember talking about this, the fact that they were starting to move higher off of their rising 20-week moving average. Even though they did all that, they really didn't do much more than the S&P 500, a little slight outperformance, and then right back down. So McDonald's is in trouble technically for a couple of different reasons. Number one, obviously, their own breakdown on their chart is bad, but they're in a group that's underperforming the S&P 500. So this is a stock that personally I would have to see some big changes in before I would be interested. In fact, if I was in it, I'd be getting out. I don't like this breakdown below the 50-day. If we could somehow manage next week or the week after to come back up and close above that 50-week moving average, then I would give McDonald's a little bit more technical love. But we have a negative divergence. You can see the PPO steadily declining as prices kept going up throughout 2017. And now we're seeing the big volume selling to the downside, losing a lot of support levels in the process. So I'm not a fan of McDonald's. McDonald's has got a lot to do to impress me. And I guess it's going to start with their $1, $2, $3 menu, which apparently isn't impressing too many folks at this point. Let's take a look at the aerospace group, because this is one of the best areas of the market. Yes, we went up, and this is what I was just alluding to when I was talking about McDonald's. Look at the aerospace. Look at the difference here between what aerospace is doing and what restaurants and bars are doing. Aerospace trying to make a breakout to all-time highs. You can see I don't like those tails, so that's usually not a good sign short term when you're making a breakout intraday and then you go back and close on your lows. So we have pulled back. I think Boeing having a rough day today, and I'm going to pull up Boeing because I think that this is a perfect example of a stock, and Erin and I talk about this all the time. When a stock is getting hit, sometimes it presents opportunities, sometimes it's a warning sign. And in Boeing's case, I think this is an opportunity, and apparently a lot of folks agree with me because we are seeing a nice reversal off of the earlier lows. But let's take a look at Boeing on this relative chart that I like to pull up. Before we do, I'm going to scroll down so everyone can get a look at the settings. Don't worry about copying it. You can always come back and look at the video later. But I just wanted to show that because I do get that question from time to time. This is one of my favorite chart styles, by the way, because it tells me a lot about a stock all in one picture. Here's Boeing's chart. You come down here. Here's the aerospace. So I've got the industry group. Then you come down further. This tells me how Boeing is doing relative to the aerospace. So even though aerospace is going up really fast, Boeing is going up even faster. So you got a great stock within a very solid industry. Here's Boeing relative to the S&P 500. Huge move to the upside. I think this is awesome. And then finally, here's aerospace relative to the S&P 500. So we talk a lot, and many of our guests come on here talking about trying to have a portfolio of stocks where you have outperformers in your portfolio, stocks that are not only beating their peers, but they're beating benchmark indexes, and their peers are beating benchmark indexes. And I think Boeing is the poster child for a great looking chart. Again, you've got aerospace, its industry group outperforming the S&P 500, and you've got Boeing outperforming the S&P 500, obviously, because it's even outperforming the strong group that it's in. So I think Boeing, when you get a pullback like this and it, the news hits, and maybe it's the tariffs that they're talking about, whatever the news is, usually news events that drive prices lower give us opportunities from a technical perspective. And I think Boeing is one of the examples there. Now, I mentioned the medical supplies, so let's take a look at that industry group. Yesterday, we talked a little bit about the fact that it was looking horrible on the daily chart. Well, it's bouncing back. That's a really nice looking candle right now at the low down here at a key support area, getting a really nice reversing. If this holds into the close, that's a piercing candle. And if we strengthen a little bit more, we may even have an engulfing candle before the day is out. That would be a very bullish development short term on the daily chart. But I think when you step back, and we talked about this with Bruce Frazier yesterday, you want to take a step back and look at the big picture a lot of times. And here with the medical supplies group, I think if you look at this chart and you don't concentrate so much on the daily chart, you see a different picture. I think a major support level is down here at about 820 or 825. This is a level that I'd be real careful, because if you lose this level, your series of higher highs and higher lows come under pressure, number one, but you're also losing some key moving averages in that process as well. And you probably would even lose centerline support on the PPO with that kind of movement to the downside. But I actually, after trading mostly above the 20-week moving average throughout 2017, notice the most recent highs here did come with slowing momentum in terms of price action. Anytime you get the PPO with lower tops and you've got prices rising, that's at least giving you a warning sign that price momentum is slowing. That doesn't tell you anything about volume, but when I start to see these negative divergences, I begin to think about the 50-week tests and also centerline resets, what I call centerline reset, because PPOs, MACDs, PMOs, all of these different momentum oscillators, they tend to go up and back down. When prices go up, prices can go up for 100 years, but that doesn't mean that these momentum oscillators will go up for 100 years. They go up, and then during periods of weakness, you'll see them drop and come back down. But in a bullish uptrend, you're generally going to see these momentum oscillators above zero. And for me, that's the key. Now, if you move a little bit below zero, but you're looking back and you're holding on to price support, I'm okay with that. It gets to the point where, how many excuses are you going to make? But price support is clearly always my most important area that I want to watch. And for me, I think it's this 820 area on medical supplies. So I think this is a pullback of pretty nice proportions, down 116 points right now, which is probably about a 12 or 13% pullback off the recent high. I think this is an opportunity in this group. Let's see what else we got today. Well, the news out earlier, Microchip, MCHP, is acquiring Microsemi, MSCC. And I think someone mentioned MSCC in the chat the other day. I think they liked the stock, and hopefully they owned it today, because Microchip actually agreed to acquire MSCC for $68.78 in cash. Now, when we look at the Microchip chart, a lot of times you'll see an acquirer buy a company, and the acquirer stock gets hit really hard. And usually that's because of a stock transaction, not a cash transaction, but a stock transaction. And I personally feel much better about cash transactions because, number one, company has enough cash to make the deal, and or maybe can borrow at a fairly low rate. We're still close to historically low interest rates. So I think it's always a better idea to pay cash. If you buy a company with your stock, you're essentially flooding the market with more stock. At some point, those that are receiving the stock, they'll probably have restrictions initially, but they're going to be able to sell that stock back into the market. So you've got a dilutive effect. And so many times, unless an acquisition is going to be immediately accretive, many times you'll see the acquirer drop back down. But in this case, check out what's going on with Microchip. The market actually likes this deal. Microchip is up almost 3%. And if we go back to MSCC, the company being acquired, is only up 4.5%. So MCHP getting a lot of love for this acquisition today, which I think is a good thing. A couple other industry groups. Let's go back into the home construction. I think that some of the consumer areas are getting hit a little bit, despite having that consumer sentiment number out today. I'm also going to show you a couple of retail stocks in a minute because we had a number of retailers report earnings. But here's home construction. Still not really seeing anything yet. We do have a positive divergence, but I would like to see some kind of maybe a exhaustive gap down similar to what we saw on the medical supplies index with a big engulfing candle. Something like that may get me interested in the home construction group. But for now, I got to watch it from the sidelines. Some might argue interest rates are going up and that's bad for home construction. I would agree if interest rates get to a certain point, but I think historically interest rates are still pretty low. So if our economy continues to expand and jobs become more scarce and people make more money, I don't think interest rates are a problem for home construction right now. I think it's an excuse. And eventually, I believe this group's going to turn back up, but I have to see it first. Another group that is taking it on the chin, home improvements, DJUSHI. Check out the failure at the declining 20-day moving average and new lows beneath the February lows. Again, this is showing relative weakness. We know that the S&P, the Dow, the NASDAQ, all of these indexes have not taken out their prior lows, and here you have home improvement retailers doing just that. Volume is not light either. So this is not a good development. I think this is an area to avoid for now. Finally, the footwear group. I think this is an opportunity. We've got a group that continues to put in higher highs, higher lows. You got a bearish engulfing candle after a breakout. That was a short-term negative, and we have pulled back off of that. But if we look at the weekly chart, you will see this is a really strong group. We made a big multi-year breakout. I think anything down to that rising 20-week moving average actually creates quite an opportunity in this space. A couple of stocks very quickly. We did have Foot Locker report. This is ticker symbol FL. They missed on their top line, but barely beat on the bottom line. Market was not interested. You can see all the way back down testing this gap support area. If that holds, we could see a bounce from there. Another big one, and going to end with this one. This is gap. I actually think this is a nice looking chart. I like the volume coming in, the gap back up above the recent highs, but we may be suffering through a little bit more consolidation with GPS. If I pull up the relative chart, you can see that the stock has been doing well. The group has been doing pretty well after being in a downtrend. And on a relative basis, I think we're sideways consolidating within GPS within its peers. You can see GPS relative to the S&P 500 just broke out of a downtrend with this earnings, which I think is great. And the actual group, the apparel retailers, not far from a relative breakout. So this is one to watch. And with that, I will turn it over to Erin for her workshop.
All right, let's get started. Okay, so today I'm going to talk to you about analysis by paralysis, too much information kind of thing. So these are really, I mean, these aren't the big be-all, end-all of how to avoid information overload or analysis by paralysis. I just wanted to give you a few hints and explain to you how I avoid it and how you can maybe avoid it yourself. It's really hard when we're in this type of a business, when there are so many indicators, et cetera, out there. There's so much information, it gets very difficult. So let's get started here. So first of all, of course, well, what is analysis by paralysis? I think everybody pretty much knows, but it's really overanalyzing or overthinking. And then because you keep doing that, you never take action. And then you get to watch that stock you almost pulled the trigger on take off, and you're sitting on the sidelines. So that's kind of the idea. We have so much information here at Stock Charts. It can get very difficult. So do you recognize these in yourself? Are you overwhelmed by the variety of indicators? I ran into this constantly at decisionpoint.com because our homepage had, I mean, probably 100 links to different indicators. It was all on one page. And so people would get there and I would get the customer service calls. Hey, what the heck am I supposed to look at? There's everything here. So here, you know, I'm going to show you how to work out that. So you don't want to overcomplicate a decision with too much information. And that's the hard part, really, is when do you stop? When do you stop looking at stuff to make your decision? Do you need those multiple confirmations? I mean, we all want some confirmation before we go and invest or, you know, take action on anything. But you don't want to have to keep looking. I don't trust this, so I'm going to go find confirmation elsewhere. I don't trust that, so I'm going to, and it takes up your time, and you might miss out. You're compelled to pick the perfect investment. Now, I put the plus minus next to it because it can be a minus because you can wait around far too long. But the plus is because you all know, if you've listened to me, I always tell you to wait for a good chart, to wait for that perfect investment. But you don't want to wait too long, and you want to trust your instincts. So there are plenty of charts to look at, and you can always find one that looks probably better than the next. And again, if you have your analysis process in line, then you're going to find those charts. You're going to trust yourself. And that's really the next one, is you have this deep fear of making that wrong decision and losing lots of money. Of course, we all have that. That is just normal if we're going to get in there. But there are ways to avoid the fear of it. So here are some of the general guidelines. And again, this isn't going to be a hugely long presentation. Okay. Is my slideshow not going? Somebody, is everybody?
I see your screen, but I'm seeing all the other slides on the left-hand side.
Okay, let me fix that. Thank you for letting me know. Let's try it this way. How's that?
Yep.
Okay.
General guidelines up. Yep.
All right. So I'll just look at this next chart again, just so you have, so you can see what's going on here. So, do you recognize these things? And like I said, finding the perfect investment, trying to find too much information. And then really, I think the big one is fear of making a wrong decision. That's why you guys watch this, because you want to know, you want to get confirmation, right? That's why you give your symbols in the 10 and 10. I'm sure it's not just for, you know, exercise sake, I would imagine you put those symbols in because you want some advice. So the general guidelines, I would say, to avoid this analysis by paralysis or information overload. First of all, keep it simple in terms of what you do and your process. Keep it as simple as possible. And, you know, the more streamlined you get, the faster you can get through information. What I suggest is in your trading accounts is differentiate them. You know, even if they're not in a completely different account number, you know, differentiate your time horizons amongst your trading accounts. I have, for example, with different objectives. So I have my IRA funds. I have them in a couple different accounts, so I have a few different time horizons. And so that gives me different objectives, you know, the risk tolerance and that sort of thing. And then I have the fun account, my cash account. I call it the fun account because that's the one I can get in and I can actually access those, the money that I make on the trades. And so it's very exciting. That's my exciting account, really. The rest are, my objective is really, of course, to grow it. I don't necessarily need to find the best pick ever, but I want something that's going to at least, you know, meet the benchmark of the S&P. So far, I've had pretty good luck with that. Start with your big picture and work down. Okay, so I mean, I know that a lot of people talk, and we don't do it that much here on Market Watchers Live. Start with those monthly and weekly charts. Start with the market in general, and then work your way down. And I'll be showing you a little bit more about how you can do that. But the idea is you go to those longer term charts and then you work your way back. For day traders, for people who are short-term traders, okay, maybe you start with the weekly and work back. If you're really short-term horizon, you go to the daily, then you go to the 60-minute, and then, you know, so start with the bigger picture, the longer term that suits your objective and time horizon, and then work down. Develop your workflow. This is critical. This is absolutely critical to saving your time, to trusting yourself and what's going on. You develop a workflow that you stick to. And I will be discussing mine. And I even have an article out there that I wrote quite a long time ago about developing a workflow. Understand your risk and reward. And, you know, if you want to just take it in a simple format, you know, again, stops and targets, you know, understand that if you have to hit that stop, how much will you lose? And determine what your tolerance is. And then look at what the reward is. Is it worth it to get in? Is the reward level pretty high? So if you understand the risk you're taking, that takes some of the fear away because you've prepared yourself. It's sort of like when I went to Las Vegas. I have all my money and my idea is, yeah, I want to hit the jackpot. I want to do really good. But I go in knowing that more than likely I'm not going to come back with the same amount of money. I might, but I'm ready to tolerate that loss because I'm going there with, rather than going in with, I'm going to win the jackpot. I mean, I'd like to do that. I go in just assuming that I'm going to lose some of that money. So if you kind of go in assuming the worst case and you determine that that's not going to bother you greatly, then go. That's what I'm talking about with understanding your risk and reward. And if you make a mistake, don't beat yourself up. Admittedly, I had 2 stocks in my account and one just took off and did great. And I had another one and it just failed. So I really almost came out even. And while I'm really mad at myself, hey, I learned something. You know, I need to pay closer attention to the stops, or I need to, you know, maybe tweak my workflow to make sure that I don't end up sitting on the wrong side of a trade. So what do I do to avoid analysis by paralysis? Well, I first of all had to determine my indicator set. What is it that I trust? What works for me? Am I making these paper trades, or am I making these trades and we're not getting successful? All right, I need to try something different. So it's trial and error. But at the same time, I had expert advice to help me. And I mean expert advice, not sitting down with, you know, John Murphy, although I've had the opportunity. You know, I've read books. I have read blogs. we have the guests here and, you know, Chaikin money flow. I haven't really paid that close of attention to it. I don't use it on my charts. But after hearing Mark Chaikin, I'm like, well, I might give that a try and try some trial and error with it. But I'm not going to add in like, you know, 5, 6 more indicators. That it's just too much to read. So you need to find the ones that you're comfortable with that work for you. And you know that Tom and I don't have the same indicator set, but we still come up with our own, you know, recommendations and the things that we like. And we're both, I would say, fairly successful at it. So, you know, you don't have to duplicate somebody else's workflow, but find those things that really interest you that work on your daily charts, on your default. So here is the workflow that I do in a very general sense. So I'm looking at the first thing is big picture. I want to know what the S&P 500, the Dow, the NASDAQ, I want to know what their condition is, meaning I want to know, are they overbought, oversold? Is the PMO positive, negative? Where are the, now I move to trend, where are the EMAs? What kind of trend model signals do I currently have? So if I have a comfort level on what's going on in the market in general, I want to go with the direction of that. So I want to have that big picture. I want to know where the river is actually flowing, the big one, the big part of the river. And that way, when I go off on a stream, I'm at least going in the same direction and I'm more likely to be successful. That's my workflow. The next thing is I start looking at the sectors and the decision point. I call them big four: dollar, gold, oil, and bonds. I like to have an idea of what's going on in those areas because I need to know where I want to focus my investments. Where do I want to go look? So this gives me a good feel for, again, what the general market's doing, but also possible places that I should really narrow down and look at. And then from there, that's where I start looking at my individual investment decisions. So that's my typical workflow. But you all know I follow sentiment indicators. I look at the McDonald oscillator and all of that. So what I do is I chunk my information. I don't go through every single chart every single day. So I have my weekly studies or my weekly checks. You know, I read Carl's Friday wrap up in the Decision Point blog, because that gives me my weekly check. He goes through the weekly charts for me. He lets me know what's going on with the big four. The studies I'm talking about are possibly, you know, I want to go in and see what's going on with sentiment. I want to go in maybe and see what's going on with the McClellan oscillator or breadth or those types of things. So I kind of set it up that I don't look at it every day, but I make time for it during the week sometime to flip through those charts. And honestly, doing this show has made this far easier because I have to do those weekly checks no matter what, because I'm presenting stuff to you out there. So I need to keep up with that. But the best way, again, set it up that you have your weekly checks or your studies. That's what I do. I chunk my information. I don't want to grab it all at once. Sort of how you set up your goals. You know, you don't just immediately go for trying to figure out the big goal. You chunk it. You take smaller projects and then you break them down and you break it down. So how might you avoid paralysis by analysis? As I said, keep it simple. Come up with a workflow. Trust your process. You have to do that. How are you going to feel good and not fear getting into an investment? You have to trust your process. And if it didn't work, if it continues to maybe have problems, then start tweaking it. You're learning. You're learning that, okay, maybe I'm reading that indicator wrong. Maybe that indicator doesn't work very well for my trading process. Let's look and maybe switch something out and do something else. Watch Market Watchers live. I mean, come on. We give you the big picture. We give you the news. You get sector and industry analysis. You get this every single day. Tom does an excellent job at setting this up and giving you that news and giving you that analysis right up front. And, you know, I need to know that. You need to know that. So you can understand where the condition of the market is, where the big river is flowing, so that you can follow the flow and not try and swim upstream. build workflow chart lists. And I'm going to show you a few examples before I finish with this. And again, I've given you an article out there I'll show you with information on how you could build these chart lists. Now, of course, if you are a basic member, you only get one chart list. So I think this still is applicable, and I'll show you how when we get further. And again, trust your process, trust your analysis and indicators. You're not gonna be successful every time. We aren't, and it's okay. You're learning, but the key is you'll have a better trust. You'll have more comfort level in your decisions if you trust your process. If you follow the same thing, and again, you tweak it as you learn. You get information from experts, and you read books. And you save some time for education if you don't trust your process. Start going through and aligning that. And I can recommend Dr. Alexander Elder. He has written some great books, and I know that I believe it's in the Trading for a Living. No, I think it's in Come Into My Trading Room. But he actually has checklists and things to help you with checking up on your investments and what you do every day. So it's a great way to get yourself set up with your process. So let's go, and I'm going to show you how I set up some of my chart lists. All right, I have, and I think I checked, over 200 chart lists right now, which can seem very overwhelming. But if they're organized, it's really not a big problem. So I have, of course, the ones up top that are very important to me that I want to look at nearly every single day.
Hey, Erin.
Yes.
I'm still seeing your last slide. I'm not seeing any charts.
Thank you so much. I was on sharing my desktop, and then when that wasn't working, I shared the actual. There we go. There we go. All right. So here's my chart lists, quite a few of them, obviously. Put the one on top that matters to me most and developed it. I actually share this one. You can find all of these charts in the Decision Point Live chart list, which you can get at the top of every Decision Point blog article. So all of these are there. They're all annotated, and I've numbered them in a way that I can go through them exactly as I need. I've got my daily, weekly, monthly. In the middle here, I have the S&P 400 and 600. Notice that I number them because, it automatically gives you the name of whatever it is. And so you want to name it and organize it in the best way possible. Carl actually showed me this sort of a naming system. We were actually doing that with our files that we were using to produce the reports and such that were on our old Decision Point site. Then I have my indicators that are very important to me, and the big four, daily, weekly, monthlies. So it's all in the same place. If you want to know how to do this, this is the article I wrote back in 2014. It was right after I came here to Stock Charts. So I had to create my chart lists. I needed a workflow chart list. So as I was doing it, I figured, well, let me tell everybody else how to do it. So that's where you can find that information. It's a December 20th blog. But if you just type this into the search block, you'll get that article. It'll come right up to the top. So that is what you might want to look at. And oh gosh, I know I wanted to cover one more thing. And I'm trying to remember what it was. So as far as the setting up of these lists, I have downloaded the Decision Point chart packs. So it automatically organizes it for me. I'm going to go down to those. Okay, so I have the intraday chart pack with and it just goes down. So these are organizational. When you download the Decision Point chart packs, you automatically get all of this. So I have all my market indicator studies. So if I want to start with an indicator and check it across all of the markets, that's in my market indicators chart pack. If I want to start with an index and then see all of the indicators for it, That's in the straight shots chart pack. So I can go into, for example, the S&P 500, and in that chart list are all of the indicators that we follow for it. So for example, here are the AD lines. And so it's already organized in there for me. So if you want to get chart packs, and there's also something very handy in there too. And you go over to your account. And this is where you can get those chart packs. Just manage them. The decision point ones are free. But I really want to talk to you about this particular chart pack, the Stock Charts Essential. It's free, and this does give you your basic charts. You get 13 chart lists, and then what in addition you get is this organization. Because when it downloads those chart lists, it's already numbered, and you're already set with your basics. It's a great way to order, get that first set of chart lists up there, and then you can start working through, your chart styles, etc. So anyway, that completes my analysis by paralysis. And again, I'm gonna, I'll have to share again, but just do check out the workflow chart list. I think that's really the key. Is if you have your set of news that you get, your set of information, and you have it in a workflow, that saves you time. And again, you get practice with your analysis, you get practice with your indicators and such. The main thing is get it down to what you trust and what you like, and go from there. So it definitely helps. And then as far as, again, in big picture, chunk your information, I think that's also very helpful. With that, I'm going to pass it back to you, Tom, for some momentum sleepers. I will be lurking in the chat room. If anybody had questions, I'll look those up. And we're still taking 10 and 10 for a little bit longer.
All right, sounds good. I do want to let everybody know you mentioned the chart pack download. Because it is more than one chart list, you wouldn't be able to do that with a basic membership. You would need to have the extra.
Yes, which, when you're looking at, creating these chart lists, I think it's really important to have the ability to, take it past that. So, you can have all of the information organized for you.
Yeah, I would struggle with one chart list at this point.
Yeah. And again, the key is also, organize them in the right order so that it fits your workflow. So you're not jumping all around, to find what you need.
Yep. And you know right where to go for it.
Yep.
Okay. So let's jump into the momentum sleepers. I do want to just let everybody know this is a segment. It could be a variety of things, but when I think about momentum sleepers, I'm thinking about stocks that are solid trading candidates on the long side. I still am going to trade this market from a big picture view that we have a bull market in play. So I'm still looking for longs. I found it interesting. Talking to Mark Chaikin on Wednesday and then Bruce yesterday. They have no problems taking short positions during bull markets, and I know a lot of traders are like that. Getting back to Erin's earlier point, I like to go along with the flow of the river. I mean, I just think it's harder to find solid short candidates when the market overall keeps going higher. And now, last few weeks we could argue back and forth. There's certainly been some opportunities, much more opportunities recently to short because of all the volatility. But bigger picture, I'm still looking at the market going higher. And so I'm trying to use these pullbacks as opportunities to go long rather than trying to use the pullbacks as an opportunity to profit on the short side. But everybody trades differently. And if you can make money shorting during a bull market, go for it. I mean, I wouldn't change a thing if it's working. But looking at momentum sleepers, I want to find stocks that are still good, solid, relative performers that have pulled back. The market's bringing them back. But on a relative basis, they still look good. Maybe they're outperforming their peers. There's got to be some other things that I look at. So let me go ahead and pull my screen up, and I'll start with Twitter. This is one of the highest ranked, may still be the highest ranked stock, scooter rank at Stock Charts right now, and for good reason. I mean, Twitter's made a huge move, even with the market struggling in February. Look at what we've done in February. The selling we've seen the last 3 days, look at what Twitter's doing. It keeps going higher. So Twitter, I think, looks really solid. I think this is a bull flag. We got the whole flagpole right here. All this action in here is just consolidation. I believe a 20-day test or maybe price support at 30 would be great entry into Twitter. And when we look down this relative chart that I like to follow, you can see, all right, there's Twitter's action. Here's the internet space looking pretty good, continuing to move higher. Here's Twitter relative to the internet. All of a sudden, huge breakout in relative strength among its peers. Obviously, doing very well versus the S&P 500. And then overall, I'd say that the internet space relative to the S&P 500 is a good area to be in. We got the steady kind of upward momentum in relative strength on the internets. So I think Twitter is a stock that kind of fits this mold as momentum sleeper. It had a huge move up recently with the gap up. Now it's just kind of quietly drifting sideways. I expect the next big move on Twitter is going to be higher. Let's take a look at the next stock that I have, which actually I do own this one, and we've talked about this. This is Snap. And I'm going to look at these in the relative charts. I just think this is a good way to look at it, especially when you're looking for momentum sleepers. Here we had a stock that had been downtrending for quite a while. I wouldn't have touched Snap for a while. This, to me, is a game-changing type of candle. Massive volume, 240 or 250 million shares, gapped up, huge hollow candles, telling me there's a lot of accumulation. And then we get all the selling to come back down close to this area. Now, we did have a little bit of a head fake, and I think I mentioned last time I talked about Snap, I wouldn't be surprised if we'd see an intraday break and maybe go down to the 1650 area. To be honest, I was hoping it would just be a tail and we'd come back up and close above. So I kind of had to hold my nose one day and hope that Snap would make a snap back. And it did, and it's coming back. But the thing I like about Snap is not so much what's happened here the last couple of days. It's what's been happening. Again, you've got an internet stock. So internet stock's doing very well. Snap, relative to the internets, was performing horribly until it came out with its earnings news. And again, I think that's a game changer. I think now we're starting to see the relative strength again picking up. Snap, relative to the S&P, also broke a downtrend. And again, internet's doing very well. So those are a couple of sleepers. I'm going to do one more from the technology area. Open Text. I also own this one. Actually, it got a 50-day test today, which I thought was pretty bullish. Open Text gapped up. This is earnings right here. Huge move to the upside. Had this rally from 34 and change all the way up over 40 intraday. Came back to 38 and then came all the way back. Well, if you look at its history, it tends to do this. Gap up, fall back, gap up, fall back, gap up, fall back. But the overall trend, the rising bottoms here, I think looks pretty bullish. On the last gap up, we've got gap support just above 34. We put in a hammer there. We've already hammered out that bottom once. And you can see with today's low, we hit the 50-day moving average and also just about down to this gap support area again as well. So OTX, I think, looks really good. It's in the software space. This is even better than internet. Here's your software stocks, which put in a higher high, moved to an all-time high just a few days ago. OTEX, relative to the software, has been downtrending, but again, you've got the best group out there, and you just recently made a huge breakout with earnings, and this is not going to help you on a relative basis when you come back and fill a gap and consolidate. But what I'm paying attention to is this uptrend that's in play. I think OTX is going to move higher from here. If it doesn't, I'll take my loss. But we go down the list here. You can see the downtrend relative to the S&P 500 broke. We're starting to see some more relative strength, and this is what really gets me excited about stocks in this group. Is that software is one of the strongest areas in the market right now. And this relative strength line is what tells me that. So if I'm trying to outperform the S&P 500, for me, I want to try and find stocks that I really like in the software space because this is where money's rotating. Let's see. I got a couple more for you. I'll try to get through quickly here. Let's take a look. This is one that I'm actually getting beat up on a little bit right now, but let's take a look at MTOR. Actually, it's coming off the low, so I'm not getting beaten up quite as bad. I actually got into it yesterday right here on the gap support. I have a second entry if it gets down to 2250, or maybe it's 2275. It's somewhere above this low, and that's going to be my stop. Notice there's also a massive gap support here. I didn't annotate this, but you could see this line coming across here. Gap support, that's what I'm looking to hold. Now let's go down the line here. Commercial trucks, our commercial vehicles here. Beautiful move up. We did pull back. We're consolidating. I think what we're going to end up seeing maybe is some kind of a bullish wedge in this group, but this was a huge run up in the group heading into the beginning of the year, and we're just pulling back. And so I think MTOR is pulling back with it. Volume trends on this move to the upside, by the way, very, very strong. So I like this pullback. Looking at MTOR versus the S&P 500, huge move up with those two big volume days, and we've worked our way all the way back down. But overall, I see still a group that's going up, or a stock that's going up relative to the S&P. And here's the group relative to the S&P. You could look at this and say, well, it's been down for the last 6 weeks, doesn't look that great. But just keep in mind, there has been tremendous outperformance in this group for about 4 or 5 months. I'm willing to give it a little bit of time to settle down, to consolidate, and allow me to get into a position that I believe a stock in that space looks really good and is getting down to what I consider to be very significant price support as it gets closer and closer to that 22.5 level. So MTOR I thought looked kind of interesting. So I'm going to go ahead and wrap up with that. So those are the momentum sleepers that I'm looking for. I tried to give you a little bit of background on why I like them as well. A couple of others I didn't talk about. QNST, we've talked about that one recently. I still think that looks good. Media agencies, by the way, I think was the best performing group within consumer discretionary so far today. Another one that looks pretty good is VIPS. We've talked about that on the show. And one of Erin's picks recently, I came up on my list as well, Tilly's, TLYS. I think that one put in a beautiful hammer yesterday. Looked like it was breaking down, came way back up off the low, and was having a good day today. So those are some of the stocks that I think look pretty interesting. And with that, we can turn it over to the 10 in 10, and then maybe, Erin, if you can, pull them up on the RRG.
I shall. All right, we got over 30 today, so it was kind of a busy request day, but I managed to get them all listed here on our RRG. And I'm going to take the tails down just a little bit and move in a little closer here so we can see where everybody has landed. All right. And now we'll add a little bit of tail in here. All right. So we can see which ones obviously are in the leading category. Those that are improving, like I said, I'll try and pick a few of those. And if you look at the table, this gives us an idea over the daily chart for daily readings for RRG. This is the table, so you can see these are in the this is leading, these are improving, these are lagging, those are lagging, and yes, improving, weakening. There we go. All right, so that's kind of where we stand, and the first one is Citigroup, so go for it.
Yeah, I saw that USX was on the top of that list in the dark green area. And that, I would just say, with the tariffs that President Trump has put on imports, the steel imports, a lot of the steel stocks, even over the past couple of days when the market was getting hit, steel stocks have done pretty well on a relative basis. And it's just because, it's almost like a little moat being put up around the U.S. steel companies because of the potential tariff on imports. So anyway, I just wanted to mention that because I saw it sitting there. Citigroup is the first one. I have some mixed feelings here, and this could be a little bit of analysis paralysis right here that I'm about to show you. Citigroup, first of all, look at the trend line. Trend line was beautiful. Look at this heavy volume gap down and losing the trend line. We go back up, we fill the gap, shooting star candle right at the top, or maybe it's more of an inverted hammer. But that's not a good candle. We couldn't get back up above it, and now we start to come back down again. The good news here is I love the banks because I do think we're going to remain in a higher interest rate environment, and banks do well in that space. So I like Citigroup because it's in a good space. But as I go through this analysis, I think you'll see that it's not going to be one of my favorites in the banking area. I marked 3 possible support levels. I think 69 to about 71.5 is an area of major support on Citigroup as we go forward. So if we do go through a period where the market, weakens, or maybe rates pull back a little bit and the banks struggle in the near term, this is an area that I think Citigroup needs to hold. It's already broken the trend line, which I'm, again, a little bit bearish about. Now, this is going back the last year or so, maybe 10 months. So if we pull up a weekly chart, maybe the trend line would be a little different. We'd have to look at that. But the bank group, very, very strong. And since the banks broke out back here in September and started moving, check out the relative strength of Citigroup versus the banks. It has been on a steady downward path. So even though, we're moving higher and it looks good on the chart, you'd be better off with a lot of other banks than Citi. So that is part of my problem. Citi has not even outperformed the S&P 500, even though banks have soundly outperformed the S&P 500. So you're in a group that's been outperforming the S&P, but if you're in Citigroup since the beginning of October, you're lagging the S&P 500. So I think that Citigroup goes higher because of the group, but it's not a stock I would be in. I know that was a long annotation and discussion, but I thought
All right. No, that makes sense. Okay. And the next one is going to be Pretium Resources in the general mining area of materials, PVG.
PVG.
Right?
Yeah, I mean, it's got to get through the 20-day first. It does have a positive divergence on the PPO. But I tell you what, that PPO was down at minus 12.5%. You don't see PPOs go that low very often. And what it's telling you is that the price momentum, we dropped so fast. We went from roughly $11 to $6.50 in about 8 or 9 trading days. So, of course, the momentum to the downside has to slow. I mean, looking at the PPO or MACD or PMO or any of these momentum oscillators, to me, some of it is just common sense. And here, when you're going down this fast, unless you're going to go to zero in the next 2 weeks, you're probably going to start turning up on these momentum oscillators, even though, in my opinion, you've got a really weak stock. So annotating this one, I would just say, first of all, I have no interest in this stock. I'll try to be clearer next time. It's the huge volume sell-off. This is distribution, a lot of distribution. I just think it needs to go through at a minimum some consolidation. I'm not going to try and catch a bottom. The falling knife has sliced me plenty of times in my lifetime, and I try to avoid it at this point. I like to see healthy stocks and get them on pullbacks, and this just doesn't meet my criteria. First step is to get through the 20-day, and then I would say the second step is just to get through that first reaction high up around 7.25. Those are going to be 2 key short-term areas that you're facing with PVG.
All right. The next one is going to be 3M, MMM.
All right, MMM, I know, came out with a pretty good earnings report, and we went all the way back down into this gap support, filled the gap. Let me just annotate that so you can see what I'm talking about. And if you're new to technical analysis, filling the gap just means when you gap up, prices eventually coming back down to where you started before the gap. Notice on this pullback, we never got there. This selling, we never got there. Well, on this selling, we did. We finally filled that gap from back there. Printed a little bit of a hammer or doji, and then back up we went. I think this is a major support level down here, by the way. I like 3M. It is bigger company, so I don't know that you're going to really have a lot of opportunities to outperform the S&P 500. But I do like the stock. I think if it gets closer to that 220 area, I think the reward to risk is very solid on the long side.
All righty. Let's see. Next one is the Russia ETF, RSX. I see a double top. My PMO just got a PMO sell signal. The way you felt about PVG, I think I feel about this one.
Yeah, I don't like the fact that it broke down after breaking out. But, sometimes when the market sells off and we get these global sell-offs, it's like everything goes down. And so what we had was a pretty nice breakout here back in to start 2018. Came back down. We had a little bit of a false breakdown, put in a huge doji, long-tailed doji before we came all the way back and set a new high. I like today's candle. And so I'm thinking that the 50-day moving average may be your short-term bottom. So I would just keep a tight stop. I think if you take out today's earlier low, I would probably be out of it. But I would trade it with a trading range in mind from 2270 or 22, what's that low, 2263, up to about 2430. That's the trading range. And so even at the current price, I think the reward to risk is probably about 2 to 1. Yeah, I'm okay with it, but I agree with you. I don't like the fact that it failed to hold the breakout. But given all the market volatility last few days, I would maybe blame it on that. Give it a shot if you like it on the long side, but I would keep my stop in play.
All right. Let's look at Skechers USA. We always look at Nike. Let's take a look at Skechers, SKX.
Love the stock, love the group. Mentioned the footwear stocks earlier, and I think that this one is I think it's going through a great period of consolidation. With all that early February selling, I mean, this stock has held up beautifully and continues to trade sideways off of an uptrend, which I think is a precursor to a breakout. We're almost ready to break to a new high. I'd watch for that. I wouldn't buy it here because you're not making that breakout. We could turn right back down toward the bottom area of the sideways consolidation. So I would either be a buyer on the breakout with increasing volume, or I would be a buyer if it pulls back closer to 38.
All right. Let's see, the next one, IRDM, Iridium Communications.
All right, IRDM. Well, failure at resistance. I think that's pretty clear to see. And now a nice kick save at support. So a couple of things here, and this is why I love candlesticks. But this was the breakout. This would have been the breakout. We gapped up and we're moving higher that particular day on heavy volume, and we failed. That is normally not a good thing and normally leads to more selling. And again, the market overall is not helping things. But that was the reaction low back here in December, and we've now gone back and tested that twice. Volume has picked up to the downside, though, so I would keep my closing stop at 1120. I think if it breaks and closes below 1120, I'd be out. Otherwise, I'd be looking for it to move back up toward that 1280 area.
Okay. This is for our Canadian friends. Enbridge Income Fund Holdings, ENF.TO.
Okay. Well, I mean, a lot of these income funds are not doing very well. The stock market's outperforming many of these, fixed income alternatives. So you possibly have a double bottom going in here. So from a, strictly playing support, you could take a shot with it. I mean, this is not what I'm looking for to outperform in the current market environment. You can see we're right back down close to that low candle body. So you could certainly trade it for a bounce, but we're talking about maybe 75 cents to a buck. And so it's not really my style, but I would just watch the support level, because if it doesn't hold, I would be out of that position.
All right. Let's see the next one. How about Starbucks? It's having a great day. Did you reload your card today or something?
Wow, you're just full of them today.
I know, right? It's Friday.
Wow, you must be getting pumped up for that Ducks game.
You betcha.
Yeah, well, as a matter of fact, I reloaded yesterday, so the news must have hit today.
That's right.
Yeah. I love Starbucks. I do think that from a short-term perspective, it's got issues. There was a big gap down right there with its earnings, and we came back up, and there is your shooting star candle off of an uptrend, failure above resistance. So, of course, yesterday we came back down. Let's clear. I mean, a close above 58 would be very, very good news for Starbucks. So with it sitting at 57, I'd probably wait and see if I get that next dollar and get that close above 58 before I get in. Because otherwise, if you have one of these failures and you move back down towards support, you're not going to be happy getting in at 57 bucks. So I would wait, but I do like Starbucks. I think their long-term chart looks great. It has been a consolidating stock for a long time, though. So it could be frustrating for a trader getting in, but eventually I do look for that longer-term breakout on Starbucks.
All righty. Let's see. The next one is going to be BBC, Virtus Life Science Biotech Clinical Trials. Man, the OBV. But I mean, obviously with that volume pattern, but wow.
Yeah, it's first of all, I think that the setting a new high in the market environment that we were in is awesome. I'm not familiar with this ETF, so I don't know exactly whether this is made up of I'm assuming it probably is a lot of smaller companies. And I don't know if you all have noticed, but when we've talked about the scooters recently and we've pulled up mid caps and small caps, almost everything at the top is either pharmaceutical or biotech. And so a lot of these smaller companies are doing well. And part of the reason is you get a lot of them at the top, but you also get a lot of them at the bottom because they're a very volatile group. And when they start moving to the upside, their scooters jump very quickly. So that's why you see a bunch of them. But anyhow, I think I like the fact that this one on a relative strength basis breaks out and now is holding its rising 20-day, bouncing off of it. So I could get behind this one. The problem is where it's trading now, and it's so close to resistance. I would like to see it pull back one more time. I would love for this to get back down to around 30 because then I could manage my risk. I could actually set a closing stop probably somewhere in this area. Notice the prior high over here kind of coincides with this candle, and look at all these tails in here. 29.75 to 30 would be great support, but we're looking at 33.72. We may not ever get back down there. If I went long on this, I'd probably keep a closing stop at the 20. If it falls below that, then maybe you have a shot down here around 30. But I do like the group. I like biotechs. I've talked about that before. But this particular ETF breaking out to a new high, I think, shows some nice relative strength.
All right. And our last one, big old large cap. How about Micron, MU? I was actually looking at the 10-minute bar chart on this one just because it was such an interesting OHLC bar on my daily chart.
Yeah, this one is getting close to resistance. Any of these stocks that are near breakouts, I think you got to hand it to them. I mean, given all the volatility in the market, especially when things get volatile, a lot of times the first thing you want to get rid of are the stocks that are so aggressive. And yet many of the aggressive stocks are holding up. Technology in general has been holding up great. So I'm pretty bullish. And what I'm looking at is an uptrend. And a lot of this sideways consolidation, ultimately, I'm looking for a blowout through 50 to the upside with volume. And I think that starts the next leg on Micron. So I'm bullish, but the problem here is you're almost right up against resistance, making it tough to enter here.
Mm-hmm. All right. Well, that concludes the 10 and 10. And you should be seeing the symbols right now. There they are. And we will have these up in the Market Watchers Live chart list, which you can find at the top of the Market Watchers Live blog under the blogs tab. And with that, I'm going to steal that screen back and talk to you very, very quickly about ChartCon that's coming up. So I'm going to just flip it here to the top. If you go to stockcharts.com/ChartCon, you will be brought to this lovely page. We're going to be doing a convention, chart convention, so to speak, on reducing risk. It is online. You can register and you don't even have to be there that day or days. You're going to get all of the recordings for all of this, and you can enjoy it right from the comfort of your own home. We have an incredible lineup, and you can go check that out. Additionally, if you're interested in getting more out of the conference, we do have a limited number of seats for VIPs to actually attend it in person in Seattle. And we'd love to hang out with you, talk to you over a glass of wine for me. And if you want to continue the fun and have a great summer vacation, we're going on an Alaska cruise right after that. I can't wait. And you can hang out with us more or try and hide around the ship so you don't see us, whichever works.
So. Just don't throw us off the boat.
Exactly. All right. So with that, let's go into a market update, and I will give you the latest on what is currently going on in the market as we finish up our program. All righty. I'm going to refresh this just to make sure we're where we need to be. Really interesting day, isn't it, Tom? We had a really rough morning, but we are starting to get back up toward the positive. The Dow definitely having the most difficult day of the large cap indexes. And it's still in negative. We can see S&P 500 and NASDAQ have all managed to pop back up into positive territory. And as Tom was talking about, Russell 2000 small caps right now are just tearing it up. They did have a big open lower in the morning, but they didn't take that for very long, and they have been just shooting up skyward past yesterday's intraday high. In fact, we can see Wilshire 5000 is having the same kind of day, gap down, but now in positive territory. Treasury yields at 2.84%. 1.57. We can see kind of a flag formation setting up here, so we could see them rise even further today. UUP, the dollar gap down, but is consolidating sideways. Commodities are lower. Look at this interesting flag on USO, however. So it will be interesting to see if that can execute and we can get some prices rising on oil. Gold is up slightly, had a nice move up on the open and took some time falling back down, but is now bottomed, and it looks like it's going to continue on higher. The VIX started off very high, which makes sense since we had all of those gap downs in the morning. But since then, as the markets have been rising, the VIX has been moving lower. So we're seeing a little bit more comfort, I would say, from investors. They're not feeling quite as nervous. All righty. Let's go check out our market summary very quickly. And then I'm going to get started on some sentiment, unless, Tom, you have anything to add to what we're looking at.
I'd like to add one thing when you're done.
Sure. Healthcare right now is the sector spider leading the way, up 0.75%. Technology not too far behind. Utilities and consumer discretionary are the hardest hit today. They are lagging. We can see as far as industry groups go, biotechs, network, natural gas, all leading, with airlines and REITs at the bottom of the list, of course, with utilities, which makes sense given the sector ETF. Spider was the laggard. And as far as international ETFs, we can see we're getting some Asian countries, Malaysia, Japan, Singapore, South Korea, all of these at the top. And as far as the laggards go, Sweden, Canada, Brazil, all of those down well over 0.5%. And with that, I'm going to close up our market update and get my sentiment charts ready and go for it, Tom.
All right. Sounds good. I just want to show you, this is the Russell 2000 relative to the S&P 500. And I want you to just take a look at the last few days here as the Russell 2000 has wildly outperformed the S&P 500. And that's one of the things that Erin was just alluding to in that last market update. It's taken out a couple of recent relative highs. We're now at the highest level we've been in probably about, well, maybe 7 weeks or so, second week of January. And that's coming off of this double bottom on relative strength. And the reason, well, one of the reasons anyway, I believe, is that, and this is something we've talked about a couple of different times, but the dollar had been weakening even though U.S. Rates were rising versus Germany. And usually, I mean, normally when you look through here, and I actually have a correlation indicator in here down in this lower window, where you can see that there's generally a positive correlation between the direction of U.S. interest rates versus Germany and the direction of the dollar. So in other words, if U.S. rates are rising faster than Germany, the dollar normally goes up. If the opposite is true, then the dollar usually goes down. But we have gone through periods in the past where we've had this disconnect where yields are moving higher, these red shaded areas, and the dollar is moving lower. And each of the prior two times we've seen this, the dollar has exploded coming out of this. And if I go to one other chart, not only does the dollar tend to explode, but then you also have small caps on a relative basis, relative to the S&P 500, gains much quicker than the S&P 500. So, you know, when I see the Russell 2000 now all of a sudden making this huge spike while the S&P 500 is struggling, I think back to this chart and the fact that the dollar is at a critical level. And today, the dollar is actually down. And I'm watching this to see whether or not this rising, because we haven't really had too much period for a while of rising 20-day moving average on the dollar because it's been dropping. But it has turned. And if we hold here and can move back up and take out this recent high on the dollar, I think this relative strength in the Russell 2000 is likely to continue. So that's something to keep an eye on and watch as we go forward in March. And with that, I'll send it back to you for the sentiment update.
All right, so let's get into this sentiment stuff. All right, so here's my sentiment indicators chart list. There is actually a chart list with these in that decision point chart pack. I believe it's in the market indicators chart pack, but you can look more closely. I do want to caveat that we had some indicators go away for decision point about a little over a year ago in March. So some of the, since we don't have the indicators or the data, you may have to cull some of those decision point chart lists just a bit. But this is the sentiment indicators one. I don't think I've changed much in terms of how this one's organized. So anyway, I'm going to look at the main ones that I study every week. And we're going to start off with the put-call ratios, CBOE, equity, and OEX. And you will see the data on most of these charts are showing for yesterday because you don't get the current information until after the market close. So what we can see, I was noticing, especially on this, is, typically what you want to see, investors are considered bearish as the number rises. And that's because, if you have a higher number in the numerator, you're going to end up with more, your numbers are going to go higher. So that means that we're looking at people, the investors are a little bit more bearish when you see the high readings. Low readings, they're more bullish. And remember, sentiment is contrarian for the market, okay? So when we have these highs here in bearishness, that's actually bullish for the market. So, but what we're seeing is we've had them falling. We're looking at readings, at least on the equity put-call ratio, below 1, meaning that we do still have more calls than we have puts. But yeah, it's moving down lower, so people are starting to get a bit more comfortable in the market, but we still haven't reached those oversold readings just yet. But I'll be watching to see if this can turn up. So at this point, with investors starting to feel a little bit more bullish, that could be considered bearish for the market. But with so we had these tops, and that meant that investors were feeling more bearish, which means that's bullish for the market. So generally, when you see these tops, you're going to get a rise off of them as they move lower. So the fact that we're moving lower and prices are moving lower does bother me somewhat, to be honest, because generally you see a rise after you get these tops. So we'll have to pay closer attention to that, but they're sitting mostly kind of in neutral territory right now. The main thing is we are seeing people starting to get a little bit more bullish, if anything. AAII, the American Association of Individual Investors, they have a poll on their website that I believe anybody can go take. Basically asks you, are you bull or are you bear? And so what we can see right now, I'm noticing that the readings are starting to shrink. What does that mean? That means that people are moving more neutral. And in fact, we do have a live poll going on in our chat room there on the right. It asks you what you think the S&P 500 price action will be next week. So go ahead and take that poll. I'm actually going to turn that into Wall Street sentiment along with Tom and my votes. And we'll see how everybody's feeling about that. But right now we have a lot more neutral people. And we can see that although we do have more bulls, the fact we're getting more neutral is, I think, interesting to me. And we can see the ratio is now moving lower. The number's getting smaller. So what does that mean? That means that the bears are starting to, we're starting to see a bit more in the way of bearish activity, but we're still 1.5 times how many bears we have, right? Because that's the ratio. So we're still looking at mostly bullish sentiment out there. Anything pretty much above 1 is. But we don't have very climactic readings, and people are moving a bit more neutral. So I'm not sure we're getting that much information off of this particular chart. But the one thing I would do is our takeaway is the fact that that ratio is starting to move lower. And that does mean that we're getting less bulls. And you can see that right here, that we have less bulls and they're moving down more quickly. All right. Name exposure index, National Association of Active Investment Managers. They tell us in a poll how exposed they are to the market. So where are the big money managers? You know, are they pulling back their money? Are they laying more out there? And that tells you if they are bullish or bearish. I find that with this chart, it still is contrarian to some degree. But at the same time, you know, these are the big, this is a lot of the big money. And so a lot of times they are on the right side of the market. But I always look at these extremes and then start going from there. Right now, we are at not an extreme. We've certainly seen higher readings right now, but we are seeing that exposure, if you look here in the thumbnail, is increasing. And we're now at a level of exposure that we haven't seen since earlier in the year, in October of last year, I believe that came in. Well, no, it looks like December right here for the previous top, but it's also lower than the top below, behind that. So we're seeing that exposure, though, increasing, but not to the levels that we saw before. So we're seeing active money managers being more comfortable putting more money out into the market. So that means they're starting to feel more bullish. Contrarian says that that's somewhat bearish for the market. But like I said, I caveat it with a lot of times these guys are on the right side. Like when we got this reading of 110, we've not seen that right reading since we have been tracking this particular index. So the fact that we saw the highest reading, you would think that, well, that has to be very bearish for the market when you have that much exposure. And that's how I did read it. But notice that after that, there was still a spike. So they were on the right side of the market. And with that absolutely gigantic reading, I think that turned out to be more of an initiation than an exhaustion. It's really an art to read these. And a lot of people are curious, well, why do you care? Why do you look at it? And it goes back to my analysis paralysis briefing. You know, I do my sentiment studies. That gives me more big picture information. So that's just part of the puzzle pieces that I use in my analysis every week. Some people may not find it all that helpful for them, but I do like to see the sentiment just to give me a bigger picture look at, you know, how investors are feeling with a little bit more than you get from just the VIX. And that's, you know, we pay a lot of attention to the VIX. This is sort of the same idea. It's sentiment. How are people feeling about the market? So anyway, this is the RIDEX ratio. RIDEX has a basket full of funds, and they report how many assets are in each of those funds, as well as their money markets. So what we do is we take all of those assets in the bear and money market funds, and we divide that by the bull asset funds. And that gives us our RIDEX ratio. What was very interesting was since October of last year, we were seeing quite a rise in the RIDEX ratio. It was sitting above readings that, you know, we normally get with this ratio. They were hanging out way high here. And that suggests, obviously, there is quite a bit of assets in the bull funds versus the bear funds when you get readings this high. But we've seen it pull back quite a bit, this ratio, and it's staying mostly the same right now. And that's really, when you look in the thumbnail, you can see more closely. We've got money's pretty much stagnating in the bull or the bear funds. We're not really seeing a huge increase or decrease at this point when I look at what's happened over the last week. And when I look at the money markets, it's the same deal. Really stagnant, really hasn't moved much. So we're not seeing a huge interest in moving into bear funds. Well, what about the equity funds, the bull funds? Well, we're losing a lot of ground there. It was mainly at the beginning of last week when, you know, things were looking pretty bad. But we are starting to flatten out a little bit. The main thing is people are feeling less bullish, and so they're pulling that money back. But as far as our bear funds go and the money markets, they're not putting it in there. So they're feeling more neutral. And I think that explains a lot of the readings that we're getting currently. So if we could pull up my summary chart here, I'll let you know what I'm thinking about all of this in particular. There we go. All right, so let's summarize. So the put call ratio, remember, it was topping and falling, and that's bullish for the market. AAII, remember, the investors are starting to show some indecision. We're losing the bulls. We're not gaining a whole lot in the bears. So that would be considered somewhat bullish for the market. Elevated exposure by the active investment managers, typically it's contrarian, so that would be considered bearish. We had a decrease in bull funds, flat in the bear funds and money market. I would say that that's somewhat bullish for the market because people are getting more bearish. Readings. So in conclusion, we've really got mixed. If you look at what you can add up on the side there, I would say that the put call ratio and name readings, one's bullish for the market, one's bearish. So I'd say they cancel each other out. And that really leaves us with some somewhat bullish indicators as far as sentiment, which I think makes sense. Again, we're going to start seeing people get a bit more bearish if we can continue to see some of the problems we're seeing. And that, of course, becomes bullish for the market. So with that, Tom, I think we're getting ready to the end here. Did you have any comments about what I was talking about, or shall we just finish this thing up and do our poll?
Well, I didn't have any comments on the sentiment, but I did have comments, on your analysis paralysis. We talked before the show started, and I think that you made some really good points. I thought that was a really good segment, because I know a lot of folks do suffer from analysis paralysis. I would just make a couple comments. Number one, when you said, a lot of times you make a great call, but then you don't pull the trigger and then the price moves in your direction. I would just add, and a lot of times that's when you get in. After, you made a great call, say at the 20-day moving average, the stock, moves up 6%. And you're like, wow, that was a great call. I'm going to get in now. And so a lot of times it's a timing. You end up getting in late and you wasted a lot of profits because you didn't have the conviction to get in. And so that takes me back to a comment that Mark Chaikin made on Wednesday, where he said he has his system in play. He uses his fundamentals and his tacticals. And when he gets that pullback that he's looking for, he jumps. He goes for it. And it gives him more confidence, knowing that he's got a stock with great fundamentals and also great technicals. So just wanted to make that point. Also, I think it's important to use few indicators. I mean, everyone's different. And if you like having a ton of indicators on your chart, that's fine. But I do think that leads to a lot of analysis paralysis. My charts everyone has seen for a while. I mean, I keep it pretty stripped down. I mean, I use candlesticks. I got to have my volume on my charts. Couple moving averages, the 20 and the 50, and PPO and RSI. And to be honest, I usually use RSI more from a scanning perspective than I do from actually looking at it on my charts, because a lot of times stocks, when they pull back, healthy stocks, when they pull back in uptrends, the RSI typically will hold in that 40 to 50 zone. So I like to run scans of my chart list where I pull up stocks that have RSIs between 40 and 50. So I use the RSI a lot. But when I go through analyzing stocks, I don't really talk about it a lot. But for me, the best way for me to get away from analysis paralysis is limiting what I have on my charts, because the more I put on there, and I think, again, going back to talking with Mark Chaikin on Wednesday, the Chaikin money flow makes a lot of sense to me. But it's probably going to show some negative readings when I'm getting to a point of, say, gap support on pullbacks, and I might not pull the trigger with another indicator on my chart saying, well, you might want to think about this. And the more indicators you have like that on your charts, the more difficult it is to trade, because you are looking at it saying, well, this one doesn't look right, or, this looks great, but this over here tells me maybe I should be shorting. I'm just not going to do anything. And then it goes up and you look at it and you're like, I knew it. I knew it.
Yes.
So yeah, I thought some of the tips you gave, though, was great. I thought that was a great segment.
Thank you. And here's how you can find it if you want to jot down the date. But if you just go to the big magnifying glass here, click on, search under workflow articles. You'll find other ones too that would be interesting, but mine's right down here. And then you can find out more about creating your own list. And I have to say, people ask us, well, what about Renko? What have you looked at the Ichimoku cloud? I don't. I mean, that's not part of my process. I think they're just fine. They're great, but it doesn't work for me. So I don't include all of these other analysis processes you could. And I've learned about them as part of my CMT program. But, I think that's my frustration, honestly, with that program, is I have to learn all these other things, but I know what I like and what I want to use. So, but it's good to understand and know the others. So weekly schedule, everything stock charts. Greg Schnell will be in on Tuesday, and Wednesday we have the awesome Martin Pring, who's going to come and talk to us. I cannot wait to talk to Martin. It's been a while.
Yeah, I always enjoy talking to Martin. I met him at one of the chart cons for the first time. I don't remember which one it was because I think I've now met him. I talked to him a few times. He's one of the nicest guys in the world. I mean, we have a great group
Oh
that are
yeah.
very easy to approach and talk to. So anybody who's thinking about coming out to ChartCon, trust me, you're not going to be, with a bunch of folks who are not willing to
I
go
have
out.
to say, I brought my daughter. He brought his wife and daughter, and oh my gosh, my daughter got along with his daughter so well, and his wife is a panic. Oh my goodness.
It is such a fun trip. But anyway, yeah, I just want to mention that's going to be a great show. Having Martin back on next week, look forward to that. But it is the end of Friday. It's the end of our show, last one of the week. I do want to thank everybody for being with us today. Please remember to complete the survey as you exit. It's now below the chat, so make sure you look for it. It says, how'd we do? You click on it. It's a very brief survey. We'd love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe. We'll see you back here on Monday. Happy trading.